Today I'm going to do a review of the Jackson National Perspective 2 Annuity with Lifeguard Freedom Flex Income Rider. For those that don't know me, my name is Dieter Scherer. I'm an independent fee-only financial planner. That means that I don't receive commissions for financial products, nor do I sell annuities. I've recently been asked by clients to review some annuities, so in order to help some more people out, I provided this video for public consumption on my blog, realizeyourretirement.com. This video is a companion to a blog post. So in the post I went over the general outline of the annuity, the expenses associated with different features of the annuity, and in this video I'll break down the returns you should expect from this annuity in an Excel spreadsheet. This is never really done during the sales process that many investors go through, and I think it's really important to dig into the numbers yourself before you make a big decision such as purchasing an annuity. I'd like to think this review is different from most of the reviews out there. You see, a lot of annuity reviews and annuity education sites are really just sales presentations in disguise, where salespeople tell you that you shouldn't buy an annuity until you learn X, and then turn around at the end of the presentation to sell you something. Because I'm an independent and fee-only financial planner, I don't have anything to gain for giving you a thorough analysis of an annuity, except to provide you with an unbiased look at annuities. Hopefully this video offers you some value by giving you a second opinion about this Jackson National Perspective 2 variable annuity. Now before we get started, I have to do a quick legal disclosure. This review is neither a recommendation to buy nor a recommendation to sell an annuity. I am not compensated for this review. Jackson National has not endorsed this review in any way. Before purchasing any investment product, you should perform your own due diligence by reviewing the prospectus and other materials for the product. And this review should not be considered personalized advice. This is a general video that's made for public consumption. Please consult a properly licensed professional should you have a specific question about how this product can fit into your individual financial circumstances. All names, trademarks, and materials used for this review are property of their respective owners. Now that that's done with, let's begin. Here we have the Excel sheet I've built to evaluate the Jackson National Perspective 2 variable annuity. I've baked in the formulas for the expenses over here to the left. The annuity fee of 1.3% is used. The average expense ratio of the 104 sub-accounts is also used, which comes out to about 0.95%. And the Lifeguard Freedom Flex Income Rider, which provides lifetime income, is also used. That comes out to 1.35% each year. These three expenses come out to a total of 3.6% each year. To make this review more simple, I have not included a death benefit rider. However, it should be noted that the Lifeguard Freedom Flex death benefit rider would cost about 0.8% more each year, and that's charged as 0.2% on a quarterly basis. Because this is a variable annuity, the return on the cash value of your account will be determined by market performance. To determine market performance, I've used the last 50 years worth of monthly S&P 500 data to represent stock returns, and the last 50 years of monthly data for the 10-year Treasury note to represent bond returns. A longer time frame would have given us a more accurate estimation of historical returns, but I could only get the data for the Treasury note back to about 1962, so that's where I began. Still, I feel 50 years of returns is sufficient to illustrate the returns you might expect to receive in the market. With today's historically low interest rates expected to continue in the future, the bond returns might be a little bit too high for what you might expect to receive in the future. Up at the middle of this sheet, you'll notice two things. The percent of the portfolio I've allocated to stocks and bonds, and I've set that to 60% stocks and 40% bonds. And I can change that to 50-50 or 70-30, but I think 60-40 is a good representation of how a conservative investor might invest. So then over here I have the 50-year, 30-year, and 10-year annualized returns of the portfolio. I list the annual returns of the portfolio both before expenses over here as gross returns and net of expenses after the fees have been taken out over here. As you can see, the returns of the past 10 years are far lower than the other time periods. So to be fair, I'll be using the 50 years worth of data. Now that I've shown you the data I'm going to be using in this review, let's get started on the review of the annuity itself. Annuity returns can be pretty complicated, so to make this easier to follow, I've used $100,000 as the original investment. A guide indicating what color means which in these rows is right over here. Now I'm going to assume our investors around the age of retirement, age 65, and I've mapped this out until age 95, because the chance of living past 95 is pretty small. So let's get started. Let's examine the biggest benefit of this annuity, which is the lifetime income rider. Here it's called the Lifeguard Freedom Flex account. And the net total income column refers to the guaranteed income benefit provided by the Freedom Flex rider. It starts out at a negative $100,000 because you gave the insurance company $100,000 and don't have access to it, and you won't begin to receive any income for 10 years. This stays negative until age 76, when you begin to receive income from the annuity. Now, the lifetime income base is the value that your guaranteed yearly income is based on. The surrender charges are the value of your assets that you'll be penalized if you sell this annuity before the surrender period, which is 7 years. And the contract value is the value of the subaccounts in your portfolio. Now, the surrender value is the value of your annuity if you withdrew the whole thing during the surrender period, as we talked about over here. So if you buy this today and wanted to get out of it tomorrow, you would immediately lose $8,500 of your account and only get back $91,500. Okay. So how does this income base work, and how do all of its guarantees work? Each year, Jackson National compares the lifetime income of the lifetime income base to the contract value, which is the value of your subaccounts. And if the contract value is larger than the lifetime income base, then they will take the value of the subaccounts. And the income base will be stepped up to that value. So the contract value grows at the market rates I showed you earlier, minus the expenses of the annuity, which comes out to about 2.5% per year. As you can see, the value of the lifetime income base is growing at 7% compounded each year for the first 10 years. After the first 10 years, the income base of the Freedom Flex rider grows to about $196,000. But it also has another rider which guarantees that you'll have 200% of your original investment as an income base. And 200% of $100,000 is $200,000, as you can see right there. But because you haven't received any money from your income, from your annuity yet, you still have a negative return. Now, income that you can withdraw is based on your starting age. Because we start at age 76, Jackson National tells us that we can withdraw 5% each year of the value of the income base. So that comes out to $10,000 per year. Now, it's at this point that you're starting to receive income that the loss over here, net total income, starts to decrease. And it will go and keep decreasing until the break-even age of 85 here. It's at this point that the return on the income rider is 0%. And I mean, to be honest, at this point, you would have been better off investing your money in a savings account at your local bank and earning, I don't know, 0.09%. So if we continue to look further, your rate of return starts to increase a little bit to a really small rate of return of 0.45% in year 21 when you're 86. And it isn't until year 30 where we start to get any sort of decent return, and it's still only 2.34%. Now, if we focus on the other side of the variable annuity, the cash value of your policy, you'll see that it never really even comes into play because it doesn't exceed the value of your lifetime income base. Jackson National will step up the income base to the contract value if it's higher than the value of your income base. But the high fees limit the return you can expect to receive to about 2.6%, even after the first 11 years and 2.44% after 25 years. With all the fees, the value of your annuity would last you until age 91, but at the end, your heirs are left with nothing. But let's look at, so at the end of this, you won't have any money to give your heirs. You will have just utilized the lifetime income and gotten $100,000 in gain, which comes out to, like I said, 2.34%. But if we switch these annuity fees off and instead just say let's say we invested the same exact portfolio outside of this annuity, what would it have returned? If we turn the fees of the annuity off and just keep the fees that are related to the sub-accounts, we see a very different rate of return. After 20 years of taking income from age 76 to age 95, the rate of return on your portfolio outside of the annuity is 6%, which is considerably larger. The gain on the portfolio, instead of being $100,000, is $305,000, which is, a few 100% larger than you would have gotten from the annuity itself. And that leaves you with over $200,000 to leave your heirs instead of nothing. So if people primarily buy this annuity for the income guarantee, looking back at this, I think it's pretty unfair to say that it guarantees a 7% rate of return. Yeah, it guarantees a 7% rate of return for the first 10 years, but we're looking at this for the long term. And the long-term average is considerably lower. It's 2.34%. So I think what would actually be fair is to say that if you survive until 95, which the majority of retirees won't reach, they'll probably only reach like 85. But if you reach 95, you'll get 2.34% a year in returns. And if you only reach 85, you'll break even and not have made any income from the annuity. Like I said earlier, I don't think annuities are a terrible investment. It's just that I don't think they are for everyone. And I also don't think that anyone's ever broken an annuity down for most investors as I broke it down for you today. So I hope today's video has offered you plenty of value, and if you have any questions, comments, or want me to review another annuity for you, please leave a comment on my blog. And if you found this video valuable, you can share it with your friends via email, Facebook, or another social network via the social share buttons on my blog. Again, thanks for coming, and I'll see you next time.